Money World All. Introducing your ultimate destination for all things money related. Welcome to Money World All channel. Your time is gold. Watch at 1.5 speed. Let's start.
In recent years, the global economy has witnessed a peculiar phenomenon: negative interest rates. Negative interest rates refer to a monetary policy implemented by central banks, where depositors are charged for holding money in the bank. This unorthodox strategy aims to stimulate borrowing and spending to boost economic growth. However, negative interest rates have profound implications for individuals, businesses, and the overall financial system. In this article, we will explore the potential challenges posed by negative interest rates and discuss strategies for shielding yourself from their adverse effects. Understanding negative interest rates. To comprehend the implications of negative interest rates, it is crucial to understand how they work. In a traditional banking system, individuals deposit their money in banks, which in turn lend that money to borrowers. The interest rate is the cost of borrowing or the reward for saving. When interest rates turn negative, savers effectively pay interest to keep their money in the bank. This concept challenges conventional economic wisdom, where saving is generally encouraged and rewarded. Challenges posed by negative interest rates. 1. Impact on savings and investments. Negative interest rates erode the value of savings over time, as individuals and businesses are charged for holding money in banks. The incentive to save diminishes. Consequently, people may be inclined to spend rather than save, which can lead to a higher consumption-based economy but potentially unsustainable growth. Furthermore, investors seeking higher returns may take on riskier investments, leading to asset bubbles and increased market volatility. 2. Strain on banks and financial institutions. Negative interest rates place significant pressure on banks and financial institutions, as their profit margins shrink. Banks face challenges in maintaining profitability. This can result in reduced lending to businesses and individuals, stifling economic growth. Moreover, banks may be tempted to pass on the negative rates to customers, potentially resulting in a decrease in deposits and a rise in cash hoarding. 3. Retirement and pension funds. Negative interest rates present a substantial challenge for retirement and pension funds. These funds rely on generating returns from investments to ensure future payouts to retirees. With negative interest rates, the ability to generate consistent and sufficient returns becomes increasingly difficult. As a result, pension funds may face shortfalls, putting the financial security of retirees at risk. 4. Currency depreciation and international implications. Negative interest rates can lead to currency depreciation. When investors are charged for holding a particular currency, they may seek higher-yielding alternatives. This can result in capital outflows from the country, causing the currency to weaken. Currency depreciation can have far-reaching consequences, including higher import costs, inflationary pressures, and potential trade imbalances. Shielding strategies from negative interest rates. 1. Diversify investments. In a low or negative interest rate environment, it becomes essential to diversify investment portfolios, rather than solely relying on traditional savings accounts or government bonds. Consider allocating a portion of your investments to diversified asset classes, such as stocks, real estate, or commodities. Diversification can help mitigate the impact of negative interest rates on overall returns. 2. Explore alternative savings options. Traditional savings accounts may not be the most advantageous option in a negative interest rate environment. Consider alternative savings vehicles, such as high-yield savings accounts, peer-to-peer lending platforms, or investment funds with stable returns. These options may offer higher yields or potential growth opportunities outside of the traditional banking system. 3. Focus on long-term financial planning. In an environment of negative interest rates, it becomes even more crucial to focus on long-term financial planning. Reevaluate your retirement savings strategy, assess your risk tolerance, and explore investment vehicles that align with your goals. Consider consulting a financial advisor who can provide personalized guidance and help navigate the complexities of the current economic landscape. 4. Preserve cash flow and minimize debt. In times of negative interest rates, it is essential to preserve cash flow and minimize debt burdens, with potential constraints on lending. Maintaining healthy liquidity becomes paramount. Review your budget, identify areas for cost-cutting, and prioritize paying off high-interest debts. By strengthening your financial position, you can better weather the challenges presented by negative interest rates. 5. Stay informed and adapt. As economic conditions evolve, it is crucial to stay informed about the latest developments in monetary policy and the broader financial landscape. Stay updated on central bank announcements, government policies, and global economic trends. This knowledge will enable you to make informed financial decisions and adapt your strategies accordingly. Conclusion: negative interest rates pose unique challenges for individuals, businesses, and the overall financial system. They can have implications for savings, investments, retirement funds, and currency stability. By diversifying investments, exploring alternative savings options, focusing on long-term financial planning, preserving cash flow, and staying informed, individuals can shield themselves from the adverse effects of negative interest rates. Remember, understanding the dynamics of negative interest rates and implementing appropriate strategies is key to navigating this complex economic landscape successfully.
Thank you for watching. Don't forget to like, subscribe, and turn on notifications.